Welcome to the Company Value Investor channel. In today's video, let's analyze the Charles Schwab Corporation. Okay. The current price is $44.68 per share. So for the average investor, I want you to think of the current price as your FICO score. Number one, the rate needed for Charles Schwab is 5.3%. Average investor, think of this as the amount or the credit card interest that you pay. The amount expected is the amount of capital that the corporation needs to earn in order to meet its obligation. Average investor, think of this as the amount you need to make all of your payments. Number three is the amount made, the company's real earnings, not the net profits, but the real earnings. Average investor, think of this as the actual amount you need or you made at the end of the month or on a yearly basis. And the last item is the amount needed. This is the amount of capital that the corporation needs in order to maintain its current operations. Average investor, think of this as the amount of money that you need in order to maintain your lifestyle. Okay, so in 2016, the Charles Schwab Corporation had a strong stock. The stock was overvalued and it was a profitable corporation. Why is it a strong stock? Well, in 2016, earnings per share are 1.5. Its price to book ratio 3.6 and retained earnings almost 80%. So that is what makes it a strong stock. Now, why is it overvalued? Well, currently it's $44.68. It should be, based on the financial statement information, it should be around $25 or $30. And what makes it a profitable corporation? Well, even though they did not meet the obligations and they had negative earnings, they had a lot of money under the amount needed, which means that they had excess amount of capital to run their operations. Although you don't want negatives here, they have a large excess of money that they can use to supplement whatever they need to do. But let's do an analysis for about 3 or 4 years. 2015, again they had a strong stock. It was overvalued and it was profitable. Negative, but look at the amount needed. They had a large excess of capital. 2014, again strong stock, overvalued, profitable. Negative, large here. And 2013, same thing. Negative here, large here. So it is a profitable company in the sense that it has a lot of money to run its operations. However, in all 3 or 4 years that we analyzed, the stock was overvalued. And it is a strong stock because they do have a good price to book ratio, a good earnings per share, and they do retain a lot of their, they do have a large retained earnings. Now, the thing with this corporation is that they really don't make much money on their operations. They've had, in 2016, they had negative cash flows. In 2015 and 2014 and 2013, actually 2015 and 2014, they had positive cash flows. 2013, they had negative cash flows. Now, they spent the majority of their money investing, which is it's an investing firm, so that's where you go to get your advice or your help regarding mutual funds, or you can read up on the corporation. But the fact is, 2016 and 2013 they had negative cash flows. 2014 and 2015 they had positive cash flows. Now, remember this, they need to make at least 5% on all their capital for their internal rate of return. The problem that I have with this corporation is that they've made less than 2% on their interest, on their internal rate of return. So that makes them a that doesn't make them a strong corporation. Let's take it a step further. Let's invest $10,000. So if I'm going to invest $10,000 today, at the end of 1 year, I will have a loss, and that's because personally I expect a 20% interest on my investment. They can't give me, they won't be able to give me 5%, and this is what they should be making. At best they'll make maybe 1.5 to 2% at best. So if I invest $10,000 at the end of 2018, this time I would have a loss. Let's try $5,000. Again, I would have another loss. In order for me to value this company or this stock as acceptable for me, yeah, even at $1,000, I still have a loss. So the question is this company, would I invest in this company? No. Even though they have a lot of capital needed for their operations, they have a lot of money. They're not a very well managed corporation, because in all 4 years they never had real earnings, and they were always under the amount expected, even though they're expected to earn a very low percentage. They haven't, in all 3-4 years, they were not able to surpass the 2% internal rate of return, which means they couldn't make at least 2% on their investments. So even though they've had 2014 and 2015 were positive cash flows, they're not a good company in my opinion. Again, I would not invest in the corporation because of what I just mentioned. At no time will I make a profit on them. So my recommendation or my opinion on this company is no, I would not invest in it. That is it for this video. As always, remember, keep investing.